When it comes to investing, a term you might be familiar with or have heard before is asset allocation. Asset allocation is the process of dividing a portfolio between different asset classes. The purpose of this is to balance risks and rewards based on your personal finance goals, risk tolerance, and investment horizon. Selecting individual securities within asset class is done only after you decide how to divide your investments among stocks, bonds, and cash equivalents. This will largely determine your investment results. Financial advisors once recommended subtracting an investor's age from 100 to determine what percentage should be invested in stocks. A 40-year-old would, therefore, be 60% invested in stocks, and the other 40% would be in cash and cash equivalents. This is an outdated theory, and there are multiple ways to allocate. You might be familiar with common splits such as the Buffett theory or just a traditional 60-40 split. But I'm going to go over a few ways to asset allocate that are tailored to your specific investment style and you as a person. The first thing we are going to discuss is age. Age is going to be one of the most important factors when deciding asset allocation. A general rule of thumb is the younger you are, the more risk you could take on, and when you're older and have more responsibilities, bills, and other liabilities, you want to take on less risk. While this is all subjective and changes from person to person, people who are typically younger and may still be living with their parents and or have no debt to their name can afford to take on more risk. The first asset allocation split I'm going to talk about is for the young, risk-averse investors. It's going to be the 90-10 split. So this is where 90% of the assets are in stocks and ETFs, and then the other 10% is going to be in assets that are in bonds or other safe investments. I'm in my 20s, and this is the current split I use. However, while 90% of my portfolio is composed of ETFs and stocks, that 90% is only domestic stocks. So for the 10% of this split, what I do personally is I kind of split between 5 and 5. So 5% is going to be in bonds, and the other 5% is going to focus on international stocks, which I have an ETF that tracks all that. So I do this because I like the exposure to other markets outside of the US, and also I don't need too much of my portfolio allocated to bonds due to my current risk tolerance. This is not your traditional 90-10 split, it's just something that I've altered my portfolio around. The next portfolio allocation style is very similar to the previous one I just talked about. This is the Buffett Theory portfolio. The Buffett Theory portfolio is known for simplicity. It is suitable for a wide range of investors seeking a low maintenance, high conviction investment strategy. It delivers stable, risk adjusted returns over time and aligns with Buffett's long standing philosophy of investing simply, staying the course, and letting compounding work its magic. The allocation of this portfolio is 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. This has an excellent track record and is truly the most effective asset allocation you're going to see. The next asset allocation I'm going to talk about is a 60-40 split. This one we previously touched on earlier. It's based on long-term fundamentals and backtesting. Though this backtesting may be outdated, it's still a fine split nonetheless. This is just having 60% of your portfolio in stocks and then 40% of it in fixed incomes like bonds and other government securities. The simple 60-40 portfolio has yielded stable returns during most periods in US financial history, and up until 2020 actually, recent performance has been particularly strong. And in the decade before the COVID-19 crisis, a simple US 60-40 split delivered 3 times its long-term average for risk-adjusted returns. This is a split that people look to start transitioning to once they get older and they don't need as much exposure to risk and would like more stable income to potentially retire off of. It's an okay way of asset allocation, but many have begun to argue that it is outdated and inefficient. The next split I'm going to focus on is a three-way split. This is a type of split where your asset allocation is composed of one-third in domestic stocks, one-third in international stocks, and one-third in the total bond market. This is a good split that is easy to manage, gives you more exposure to potential growth, and hedges the risk with exposure to the total bond market. This type of asset allocation can fit a wide range of investors. For the domestic stocks, this can mainly just focus on companies within the S&P 500, Nasdaq, and other US equities. For the international stocks, this can focus on ETFs that track stocks in developed countries outside of the US like SPDW, VXUS, and SCHF. For the total bond market part of the split, these can be ETFs that track all ranges of bonds from corporate, government, and municipal. They will also follow bonds with short and long-term maturities. Some ETFs that are good for this are BND and AGG. Sometimes the most simple asset allocations can do the most work. I'd put this up there with some of the better splits. The next form of asset allocation is going to be for the most risk-averse investor, which is a 100% asset allocation to just stocks. This is for people who want growth and want it now. This is an active form of investing, and it's typically aimed to outperform traditional indexes. This can be done through just investing in stocks, or the use of options as well, but mainly I'm talking about just stocks for right now. While the risk can be reduced if your portfolio is just primarily made up of ETFs that focus on broad market indexes, I'm primarily just talking about 100% of a portfolio being made up of individual stocks. This portfolio is most common with your young investors as well, given they typically have higher risk tolerance. This might not be suitable for all investors, but it's relatively common, especially to the new investors who want to buy what's hot right now, whether it's Nvidia, Microsoft, Apple, and other popular tech stocks. The last asset allocation split I'm going to talk about is the quarter split. The quarter split is going to be similar to the one-third split, just with a little more diversification, but both focus on simplicity and being easy to manage. Quarter split is where your portfolio is evenly divided into 4 quarters. The first component will be an allocation that tracks the S&P 500. The next component should be allocation to the Russell 2000 index to get exposure to small cap stocks. The third component should be allocated to international stocks, preferably the total international stock market as a whole. And then for the last component, this should be made up of bonds, typically with exposure to a majority of the bond market for more diversification. One of the better forms of asset allocation you can implement to your portfolio, I really like this split. I think all of these investment styles are fine and are subjective. Like I previously stated, the two main factors that these splits rely on is a person's age and their risk tolerance. Now, I'd like to be transparent about these forms of asset allocations. I'm going to rank them from best to worst. Keep in mind that I'll be ranking these to my personal preferences, which is of that of someone who is in their 20s and has a high risk tolerance. Of the 6 splits I've talked about so far, at number 6, I'm going to be putting the 60-40 split. This split is still functional, but it's pretty outdated and underperforms a lot of the other splits I talked about. At number 5 is the Buffett Theory portfolio. I think this is a perfect for those who just want to set and forget, but only having exposure to the S&P 500 and a little bit of bonds is pretty weak, and there are better ways to maximize returns. And number 4 is 100% asset allocation to solely stocks. If you're looking for growth, this is the way to go. However, this is very risky, especially if the strategy is implemented in an account like a Roth IRA. I think having just a little safety net where you have some fixed income exposure like bonds is better. But the 100% asset allocation is good for those young, risk averse investors. And number 3 is the one-third split. This is just so simple yet so effective. Having exposure to 3 of the biggest markets gives you diversification and more chance for growth. This gives you the chance to take on more risk with these domestic and international stocks while having a cushion of the bond market for relative stability. And number 2 is the quarter split. The quarter split is, in my opinion, slightly better version of the one-third split. The reason for that is because essentially you have 75% of your portfolio allocated to a wide variety of stocks with 25% fixed income as your safety net. I think it's more diverse and offers more growth while bearing a little bit more risk than the one-third split. And at number 1 is the current asset allocation that I use, and that's the 90-10 split. This isn't the Buffett split that I'm talking about. This is just 90% of your portfolio being allocated to stocks, and then the other 10% being bonds. Although I have a little bit of that 10% allocated to international stocks. I think this is perfect for the young investor who just opened up their Roth IRA and are looking for an investment strategy. This lets you get more exposure to growth and have a chance of building up that Roth IRA while you're young and can take on some risk. Just an overall great form of asset allocation. That wraps up how to asset allocate. Thank you for watching my video. I appreciate your time and hope you enjoy the information. If you did enjoy the video, please subscribe to help support the channel. Okay, bye.